Michael Forman, Franklin Square launched a publicly traded BDC, or business development company, last April. Ticker is FSIC, and it held up for a while, but since October it's been slipping. Why the drop?
Well, Franklin Square, we were founded in 2009, and our mission is to bring best-in-class sub-advisors and asset classes to mainstream America. FSIC was our first BDC. It was launched in 2009, and we listed it in April of 2014, so just last year. In 2014, we're actually the second best performing of the business development companies. Over the last couple months, lots of the BDCs have traded down. I think people are really concerned about volatility in the credit markets. They're concerned about volatility relating to oil. We have a little bit of exposure in energy, but we feel pretty good about where we are. Our portfolio is performing well. By the stock pulling back, what it really means is the yield goes up for our new investors. We feel very bullish long term, and our portfolio is performing well.
Well, it's got a great yield at about 9%. Talk a little bit more about what's actually in the portfolio.
We invest in loans. We make loans to middle market companies. Most of our loans are senior secured loans, so we sit at the top of the capital structure. We have almost 140 positions, and we make loans to middle America companies, domestic companies that are driving the economy, providing jobs. They can be larger companies like SunGard or 1-800-CONTACTS, or they can be middle market companies that are in the retail business or manufacturing or energy.
And if and when we get higher rates, I don't know when it's going to happen, how will that affect a BDC like Franklin Square?
Well, all of our loans are floating rate instruments. So rising interest rates will be very positive for us. We like to say our portfolios are built for good times and bad times. We'll do fine in a low interest environment, as we've seen, but when interest rates go up, our interest will go up. Unlike fixed rate instruments where they'll see a decline in principal, we'll do better in a rising interest rate environment.
And you also have 3 other funds that are not publicly listed and a closed-end fund. Talk about those and if you have any plans to bring them public.
Sure. We're the largest sponsor of BDCs. We have almost 25% of the market, so we're a very big player with a very big platform. Our partner is GSO Blackstone, which is the credit platform for the Blackstone Group, and we have 3 different verticals. We have FSIC, like the listed entity. We have an energy and power fund, and then we have an event-driven credit fund, which is the closed-end fund. So we have a very diverse platform. We manage about $15 billion in assets, so we are a large institutional investor ourselves.
And then finally, what about valuations? Are you competing heavily for a lot of the paper out there? Are you finding that you're having to pay up more for it?
Well, that was kind of the story last year. Right now, we're seeing more volatility. There's much better risk-adjusted returns for an investor like us. So we like volatility. We think volatility creates opportunities rather than real risk in the marketplace. So this is a good time to be a BDC like us investing in the marketplace.
All right. Thanks a lot, Michael.
Thank you.
And thank you for watching The Street.